Good morning, everybody. Welcome to the Flow Show. New week beginning, Monday, 15th of April. The time is flying by. Morning, Kay. Good weekend, mate?
Good morning, Ryan. Good morning, everybody. Yeah. Okay weekend, let's say. Yep. Bit of stress, of course, watching the news, etc. But yeah, decent weekend otherwise. Hope you too.
Yeah, all good here, mate. Doing a bit of decorating the kids' rooms, so up to my eyeballs in paintbrushes and whatnot.
Decorating at their
yeah,
age, they should be doing.
well, we haven't decorated their room since we moved in, so just with everything all stuff going on. So we decided enough's enough. Let's sort out the kids' rooms. So yeah, they're all getting done. New beds, new everything. So yeah. Busy. Decided to do it ourselves for some stupid reason. I'm definitely not a DIYer. And oh look, our old mate Curdy's popped up in the.
Oh yay! Hello, hey
Curdy. Yes, our good friend Curdy. Been speaking to him on the old WhatsApp chats for a while, but decided to raise his head. No doubt, offer us all lots of advice for us barbarians.
For the next 30 years.
For the next 30 years, at least. Right, let's get on to stuff. Obviously, the main news over the weekend was the Iran attack. And by and large, it's all looked a bit for show. Obviously, it's a serious matter when you're lobbing 350 drones and missiles across borders. But there was very minimal damage from those. Most of them got taken out on the way over. So it looks, as I say, like it's a bit more for show. They've been promising this response. The US have been touting it was coming. Everyone touted it was coming. You couldn't have telegraphed it more. And thus we got that. So the reaction in risk markets is a little bit of a recovery in those risk assets. But nothing huge at the moment. There is still obviously an underlying risk of retaliation and some tit for tat, possible escalation. But let's hope that Iran have pleased their population by showing that they've responded to the embassy attack. But anyway, that's where we sit at the moment. There's still a bit of a risk overhang, as mentioned, but things have dissipated a bit this morning. We shall leave that there for the moment. Over to the PBOC, who left their 1 year MLF rate unchanged at 2.5% as expected. So no further rate moves coming over there.
Ryan, are you trying to show your calendar because you're just showing the euro dollar?
Yeah, no, I'll just about to go there, mate.
Okay.
Yeah, and that 1 year MLF not on the calendar anyway for some reason. No idea why. But anyway, yeah, that was that from China. Japan, a bit of an improvement in core machine orders on the month for February, coming in a healthy 7.7%, turning around a negative from last month and smashing expectations of 0.8%. Year on year, less rubbish, was expected to fall 6%, came in down 1.8%. So maybe a bit of an improvement on that side. There's been some further BOJ sources pieces floating around that they're going to focus less on the inflation outlook and that various data must be scrutinized, not just the inflation outlook, said one of these sources in the piece. So that they're going to look at other things such as consumption, wages, and the broader economy, which they will be looking at anyway. But there we go. So it's not just inflation that is the number one thing to look at. Canada has been piping up, saying that they're in frequent contact with other FX officials abroad. Suzuki's been out with the usual jawboning stuff, not seeing any real step up in rhetoric on that front. Now, there is a G20 finance minister and central bank governor meetings this week starting Wednesday. They will run for 2 days. So there's a lot of talk about whether they might wait or get a green light from other countries. Not that they would ever ask, but some thought that intervention might be put off until they over that hump, but we shall see. If they need to intervene, they need to intervene. Meanwhile, Dolly Yen's been tickling the 154 level and finding a bit of another barrier, not official barrier, but virtual barrier, shall we say. It can't get through 154 at the moment. Do you think there's any real risk from this G20 thing, mate, or is it just going to be a load of waffle?
Wow. In theory, it's always a load of waffle. But where we are, who's going to say that there's no risk at all, right? But again, as I said last week, I don't think that they will find any support from any other central banks to curb dollar strength in general, because if you look across the board, yes, we are a bit stronger in the dollar, but there's no real pressure. We are not outside other major ranges, right? So they should not find any global support. I think stuff like Plaza or also Accords are completely out of the question. Maybe wrong, of course, but I don't think that's within the possibilities. But just getting kind of an official green light of the other participants to intervene, if so they would wish. That's more on paper, let's say. But in a way, they already have it, I guess, because other countries will see how the yen is weakening across the board against everything, including other Asian currencies as well, such as the yuan, because that's been kept stable by the PBOC. So this is just officialized support, I guess, for whatever they may want to do.
Yeah, exactly. So we should keep an eye on that, because we can get some comments just on other subjects from other people in that one as well, but that doesn't happen until Wednesday anyway. Over in the Eurozone, a little bit of data out this morning, industrial production. I can't find it. Where's it gone? There we go. Again, a little bit of an improvement, 0.8% as expected. Month on month, year on year, down not as much as last time. So maybe those green shoots continue across the whole Eurozone as a whole. ECB Simca said there's no sudden reason to go for bigger cuts than 25 BPs. Not that I think anyone's thinking of seeing any 50 pip cuts. It says there's more than a 50% chance of more than 3 cuts in 2024. ECB rates will come down both this year and next, and sees a chance of a July rate cut following a move in June. So I think this is the next thing we're going to be trading. Are they going to do back-to-back cuts, or is it going to be a one and then a pause, maybe going at each forecast meeting? There's always a trade-off between the doves and the hawks. It looks like the doves have conceded to the hawks again by giving up on the April cuts to go for a May cut. To go for June cuts. But now we'll see whether the hawks have given in and allowing them 2 cuts, one after the other. What do you think we stand at the moment, Kay? Are we getting 1? Are we getting 2? Does it even matter?
Regarding the ECB?
Yeah.
I think, it seems like give and take between the hawks and the doves, as you say. I think my base case is still June. June is a done thing. But then the sequence of it, completely open. The sources pieces that we hear here and there seem to not go in the way of successive cuts. And I think you would have asked me a month ago, I would have said, yeah, they cut successively. But in the meantime, we did see some shoots. The debate is still open how green they are, but we did see some shoots in the meantime. So will it be needed to cut twice in a row, or will it be warranted? I think, you know what? I think we will have to look at how the financial conditions are going into each meeting. if you see weaker data, I think the successive cuts are very much on the table. If we see some of those green shoots confirmed, then I think we should lean towards a one pause, then one again, the one after. Brings us back to what we've been saying before, is that they made mistakes on the one side after the pandemic, but they will not want to be making the same mistakes on to the other side now that we're getting out of the whole stuff. And then inflation still remaining a bit sticky, but then the rest of the data is really going to where I think the balance will shift between successive or non-successive cuts, and that we unfortunately cannot say today. We will have to wait for May data probably.
Yeah, no, I think that is the case. It's a question whether these green shoots continue to grow or whether they shrivel up and die, as can often be the case.
Absolutely, yeah.
In the Eurozone data. So yeah, data watching, data dependency, we're going to be doing plenty of that. I'm in two minds. Like you say, it depends what inflation does. If inflation's closer or at 2% by the time we get to June, then I think 2 cuts are on the cards. If it's still floating around 2.3, 2.4, 2.5, I think it's going to be 1 cut and then a pause while they wait and see what goes on. But yeah, I shall change my mind with the data, as is wont to do. Anyway, back into the data, looking at last week's data, Friday's data. Michigan numbers, the main data point on Friday, a bit softer in all the components, as you can see there, red, red and red. So slight softening of the bounce we saw in these numbers the month previous, but look at those inflation expectation numbers jumping back to 3%. That's going to give the Fed more sleepless nights regarding the inflation picture over there. Fed's Collins was out on Friday as well, saying that she sees in the range of 2 cuts for 2024. Is still expecting inflation pressures to wane this year. Can't prejudge when the Fed can start cutting rates. A rate hike is not part of the baseline scenario, but it can't be fully ruled out. The CPI numbers were on the high end of expectations, and because of that now sees the Fed cutting later than previously thought. Fed Goolsbee says multiple inflation readings are higher than we want and that we must get inflation back to target. The US is in an environment of cross currents, and the long arc on inflation shows it coming down from high levels. Bit of a hope comment, this one. If PCE shows better readings, that will make us feel better. And the Fed will stabilise prices, though, if PCE is re-inflating. No further comments in about not cutting at all, which both him and Kashkari touched on, but they haven't mentioned since. And no others have mentioned about not cutting either. So I wonder if perhaps the head man Powell has a little word in a few ears on the back of that. Fed Schmid says current stance of monetary policy is appropriate, urges patience on interest rate until it's clear inflation is ebbing to 2%. Bostic repeated he's got 1 cut penciled for this year and is in no hurry to cut rates. Fed's Daily says that with the CPI report, it's a good time to remind people the Fed is not data point dependent. Inflation is not falling as rapidly as last year. There is absolutely no urgency to adjust the policy rate. Need to be fully confident inflation is coming down to 2% before considering a cut. There's a lot of work to do before we can be confident, and too much discussion of how many rate cuts, there is too much discussion about how many rate cuts rather than what we are trying to accomplish. We were looking last week, couldn't find anything, but this week we found that we do have Powell popping up tomorrow evening. For those of you UK Europe, he's talking about 6 o'clock, 6:15 in the evening, on a panel thing with Bank of Canada's Macklin. So this is potentially the first time Powell will comment since the CPI data, and it's think it's going to be very important what we get from him regarding this hawkish twist that the market has taken. Any expectations for that, Kay? Do you think he's going to go with it, push against it, or walk down the middle as he usually does?
I think, that for sure, Ryan, because he always does, right? He always does walk the middle ground in the end, but he will likely acknowledge. Now, where he could, I haven't seen the exact subject of what they are all going to talk about, but where he could touch upon, if he wants to tone down a little bit those numbers that we have seen, that combination between that CPI and the jobs report, he could say that something about the quality of jobs, etc. But yeah, he will have to acknowledge those data, right? But I think the market will move on the back of it. But will he move the needle for expected cuts? That's another question. That's really another question.
Yeah.
So
it says it's on the economic outlook and monetary policy. So I've just put the shindig up there on the thing. So yeah, it's difficult.
Could be a bigger mover for the Canadian dollar than if it's on the Canadian economy.
Yeah, exactly. Yeah, I mean it's difficult because he's sort of between a rock and a hard place again. You know, he's never, as you said, he's always walked down the middle of the road and just moved gradually one side or the other depending on what the market's done. So there's no way you can ignore these CPI numbers being sticky. But he's never not maintained that they're ready to go the other way should the risks arise that they need to do so. So he's never slammed the door shut on further hikes, although obviously he preferred not to. So I think the market I think is going to be hawkish going in, and it's going to want to hear Powell say that he's acknowledging the CPI and that they might need to be a bit more hawkish with monetary policy. If the market doesn't hear that, then I think we see a bit of a reverse, but maybe not enough to turn this mood around. But if he keeps the same line that we still expect to cut later this year, then maybe that's going to undo a lot of this hawkishness that we've seen the market going. But there's a constant battle, isn't there, now, between what he's saying and walking that middle line and what the data keeps saying. You know, we're chewing through the months, and it's not changing. It's not coming down as much as they want.
No, it's not. It's absolutely not coming down as much as they want. And as a matter of fact, now let's say the other markets have reacted, but the pendulum swings are kind of stopping. If you look at the yields, shying a bit away from that 5% in the twos. The tens are in the zone 455, 460, where we may have expected that pendulum to swing into. But you know, I'm not sure whether it's him who is going to move the needle. Of course, he's the governor of the Fed, but or is the market still going to be as we should all extremely data dependent? And the first week number in the US, we are going massively. The pendulum swings massively the other way around. I wouldn't exclude it. You know. But as we've been saying, he's probably going to walk both ends of the aisle again. If he completely acknowledges, yes, it is too sticky, everything is far too sticky, and the numbers are too good to cut, then then we are going to see a massive rally into the dollar, right? Yields higher, dollar up, whatever you. I don't know down to where stocks could go. If really yields fly, because we have seen that we have passed this kind of threshold where I was wondering what level are the stocks going to equity markets finally going to respond. Of course, there is Middle East tension in there as well, but what's the level where they are going to respond? I think we found sort of the level when we started to break above 425, 430, and then we saw the rally up to 455, 60 in the US 10s. That's where the stock market finally started to react as well. But in the meantime, it's still very resilient. If you look at just the S&P, we're still at 51.5. We are not trading down at 5,000, right? We're still at 51.5. It's not as if the whole thing is deflating. It's not the case, because if you continue to get strong numbers, I'm not going, perhaps not going to hang my hat on to those retail sales today, but if you start to print a mix of good numbers, stocks could actually still hold up, even if yields go higher. I have like those algo-based reactions, another 50, 70 points lower perhaps, and then start to go higher again, because we have been in this kind of scenario that good numbers can put yields higher, but then the stocks are finding bids as well, on dips. So that scenario is still not completely to be put in the bid. I trust.
Yeah, we also had Q1 earnings kicking off on Friday for a lot of the banks, and they all came out pretty good. So, again, there's another reason not to sell stocks. So, yeah, we're firmly in soft landing territory, and we get more earnings, obviously, as the days progress, and we a better look at some of the other sectors other than banking and finance. So, yeah, we'll get to see if those can keep stocks afloat, but that's just another input we've got. But the market's like a young child. Okay, it does something, and then it looks up for reassurance that what it's done is right, and Powell's the father, if you like, who's going to turn around and say, yep, you're doing the right thing, or no, you're doing the wrong thing, and then it all has to readjust itself. So the markets move, then they pause and they wait to see whether they've gone the right way, and that's what I think we're going to get with Powell this week. That's all I've got on the data front and comment front, Kay, unless there's anything else that swung by your radar.
Move on, mate. No.
Yeah, move on. Okay, cool. Well, let's have a quick look what's coming up. It's quite a heavily laden CPI week this week, and a lot of UK data out. As Kay mentioned, we've got retail sales today, which will be fairly important, and then we've got Empire State manufacturing as well, the first manufacturing of the month. This one's been all over the shop the last few months, so not much to take from that one. A bundle of data tomorrow from China. We get to see the state of things over there. UK jobs report as well coming in tomorrow. The wages component will still be the most important number there, though we're still messing around with the ONS learning how to count beans properly. So there's still a bit of impact on that. But as I say, those wages numbers will be important. It comes ahead of CPI and PPI on Wednesday, and then retail sales on Friday. So we're getting everything from the UK this week. But back to tomorrow, Canada and New Zealand CPI data dropping, which will be important in the context that we just had the meetings from those respective central banks, which are still keeping their restrictive language. We haven't moved to sort of cut language just yet, or explicit cut language like we did with the ECB, but that might get some changes going on there. Canada CPI is expected to come in roughly unchanged, not much of a change there. New Zealand CPI year-on-year number, these are quarterly numbers. The year-on-year number expected to fall to 4% from 4.6%. So that will go the right way. That Eurozone number is the final number there, so there shouldn't be too much change from the flash. Then on Thursday, Aussie jobs, we had a bumper 116.5k jump in jobs last month. Is that going to be a one-off, or is it going to continue and we're going to start to see a positive trend? That'll be watched by the RBA, obviously also for wage components leading to inflation, that sort of thing. So that one's going to be a bit of a watch. I'm not getting up for it though, but we'll see what happens. Fully fed manufacturing, and as you can see, we're getting some housing data from the US as well. Friday, Japanese CPI. Well, we don't need to bother about that anymore now, do we, Kate? Now that they're moving the goalposts.
Yeah,
but,
It's
It's
still going to be a big marker, right, for the markets.
Yeah,
Especially it's the national CPI, so it's even more important than just the Tokyo CPI.
yeah.
What
And
I
it's
what I would
expected.
I haven't seen actually the final wage data yet in Japan, because we've seen the unionized workers' wages, but we haven't seen the global average number, have we?
Not that
I
I
haven't
recall.
in any case.
No, no. Maybe I have to do a little bit digging, see if it's popped up somewhere and everyone's just over it now. But that Japanese CPI is expected to follow the Tokyo one in just dipping a pip in the core number, with the headline coming in roughly unchanged. It's 2.8%, I think, in the headline and 2.7 in the core. That's what expected. So, yeah, we'll see if there's a big variation. Again, it's another one. If it comes in hotter than expected, then the market's going to start ramping up hike expectations for the BOJ, and if it's any softer or much softer, then the timeline's still going to be well into the future. And that's all the data coming up. Anything there that tickles your fancy in particular?
Well, as usual, Ryan, those probably CPI data. I'm going to be very interested this week in what's happening with the sterling. We've seen a bit of a mixed picture on the sterling. We've seen the of course cable coming off, but then sterling in Cross's side is still doing relatively okay. And now the market is trying to make up its mind on whether the Bank of England could go before the rest, or wait until after the rest, or simply go the whole lot together in. Do they all meet in June? Let me just double check. No, actually, yeah, they all meet in June, right? So, I mean, the big three meet in June anyway. So, and the market will. So we could see a bit of a pendulum swing there on UK gilt yields, and by correlation on the cable as well. So I think the sterling is going to be a very interesting one to monitor this week, that is firmly on my radar. I've got a tiny bit of Canada in a cross, but nothing to really put anything in danger or even make my month. But of course, the Canadian data. It's kind of this week where I'm going to, as people know, I like to trade crosses, where I'm going to be perhaps even more focusing on crosses than dollar pairs as such. Yeah, I've got a few dollars still in position, but this could be a very interesting cross week this week.
Yeah, well, the important BOE meeting is going to be May, because that's their next 9th of May, their next forecast meeting.
Yeah.
When they update their forecast. So yeah, this data is going to be a big swinger for that, particularly the CPI. Is it getting sticky or is it coming down? Yeah, I've seen a couple of pieces. Well, I don't know if it's just a generalisation now. I've seen a piece, an opinion piece on the RBA will be forced to cut before the Fed. Pieces on the BOE will be forced to cut before the Fed. It seems like everyone's talking about everyone else being forced to cut before the Fed.
Yeah,
So I don't think it's exclusive to the UK, but yeah, this data will be important, and I'm keeping my eyes firmly on this 85 level in euro sterling. We're down here again. The bounce is still looking fairly weak. So yeah, this has been a long time level, and is this data this week going to finally see it crunched? It's almost a bit like 152 in dollar yen, isn't it?
Yeah. Yeah, oh yeah, it's even stronger than that. What I would argue, because there were different things at play in the yen. Yeah, but okay, opinion pieces, we know what they are. They can people change view like they change a shirt. But no, I think as we've been just hammering on every single show that we do, is that we are data dependent. So the market will swing on the data. Flows will happen on the data. So that is why this week I think I'm going to really pay close attention to what's happening in the sterling as a whole. Yen, maybe sterling yen is a different thing. I'm not in sterling yen because the yen is a different animal. But like sterling Swiss, or perhaps the euro sterling, or sterling versus something else. This could be a decent sterling week, especially as you say that we won't have to wait too long compared to other central banks. We don't have to wait too long for the Bank of England next meeting, which is on the 9th of May, which is going to be quickly approaching once we have those data out this week.
Yeah, very much so. And I'm still got in the back of my mind that there's still a bit of a risk that these high rates bite a bit harder here in the UK. We've not really seen it in the data, although the last two inflation prints have come in lower than expectations. So maybe things are starting to bite. But as we know with the UK, you can get a great print one week and then a crappy print the next month. So yeah, it's. I think with the UK, it's always a matter of extremes. Either things are looking really crap or they're looking really good. And very rarely do you get something sitting in the middle. So I expect we might see the same with this data. It's either going to be really gang-busting good or it's going to look really, really crap. So we're likely to get a move in the quid one way or t'other. And it will take good data, obviously, to give that 85 level a crack in euro sterling. Right, what else is going on? I'll have a quick look at dollar yen. We're up, knocking against the next big figure, 154, coming up 3 pips short so far. I don't know if there's, I haven't heard of any barrier information going on there, but it seems like the big figures are holding some sort of resistance, though 153 didn't hold too much. A lot of eyeballs, as we know, Kay, on 155. Is it significant technically, or is it more significant psychologically?
No, there is. I do have an extension level, but again, I mean, you have to look at the extension. So I do have an extension level there at 155 precisely there. But it will have its psychological importance as well. But I mean, everything had 152 especially. Now we're already nearly 2 big figures higher, Ryan, and is 155 your next 152? I can imagine some barriers lying up there as well. But it's just the direction of the yen, which is just non-stop. It's don't change if you see those US numbers as well. If nothing really changes there, and if those US yields hold up, unless the Bank of Japan comes out at the end of the month, 26th, they have their meeting, if I'm correct. Yeah. 26th, unless they come up with something saying like, hey, we are ready to ramp rates higher, or they just surprise us and do the hike in the new fiscal year. Then that could turn the yen around for a while. But unless something changes in the what's happening in other yen pairs, it's very hard to fight this still. Very, very hard to fight this.
When you say turn it around for a while, can you define that? Are we talking 5 minutes or 5 hours? Because
no, I think
if imagine that dip will get bought quite quickly.
No, I think if they hike, let's say if they hike, okay, they assuming that they surprise us and they hike, I think then you will have rates also coming into a territory, those yields, and then I'm especially thinking about the 10s and above. Well, the 10 will likely hit 1%, perhaps even above a little bit. And then you could see the impact of Japanese investors starting to be very interested in JGBs again, because they will have had their first real hike. And that may get them interested. And then we may start to see those flows coming. What I've been talking about are the Japanese investors getting interested in getting back into the JGB market, especially if, as I say, if the 10-year goes above 1%, if the 20-year gets closer, perhaps to 2. I don't know exactly where we are now, but the 20s are about 165, so perhaps around 175, 180. And that could then, depending on whether they use just their cash pile or whether they want to repatriate a bit of funds, that could then have an impact. And if they get interested, and I'll be following up, I'll be following closely what they may say. If they get interested, then we may see the yen turn around for a little bit longer, because we will see repatriation, and that is not going to happen from the Monday into the Tuesday. That should be taking us for a little while, and the market will probably take it then. Will take notice of the whole thing as well. So that may be the case. The other one that can turn it around, obviously, is if we see data in the US starting to weaken. If we see data elsewhere, like in Europe, we can also that could then have a more positive impact on the yen. But unless we get the surprise, unless those data turn around, I see little now to stand in the way of moves apart from any possible interventions.
Yeah, and what obviously we're just talking hypothetical. I don't think it's your base case or my base case that they hike at the next meeting. But what would they be? Would it be a 10 pip hike or a 25 pip hike?
That's the question. They can officialize the 10 BP, but 10 BP is not. That's going to be, I think, the short-term impact. That's not going to. That's not going to support it. I think we will have a knee-jerk reaction on the yen, but that's then going to be a short-term impact, because then we will have to see what the statement is. And if they say, like the statement, okay, now a new fiscal year starts, we're taking the yen interest rates into positive, officially into positive territory, and now we wait, then yeah, you're going to have like a day or two, and then the thing turns around again. But that will all depend on what the statement is. And let's say if there's those sources pieces that came out earlier today are right, and that Ueda says we are not only looking at CPI, but we are looking at consumption and investments, how the investments go. If their investments are positive, then we may be in for a period of a bit more on the Japanese yen. But
yeah,
it's always that hypothetical case where they hike. They may keep it just still. If they do 25 BPs, that would be quite hawkish in my opinion.
Yeah, super hawkish. I think. That really put the cat amongst the pigeons, which it'd probably have a bigger effect than if they intervened. So yeah, maybe.
I'd say so. Yes.
Yeah. Yeah. We'll wait and see. It's going to be. At least we know we're going to get some interesting Bank of Japan meetings now, after waiting God knows how many years, going through boring after boring after boring. But yeah, that's for the later in the month anyway. Another one just to look at quickly: Aussie dollar. We've had the break of 65 and the 64.80 area, though it's just bouncing, but looking a bit dead cattish at the moment. As we get this bit of a bouncing risk, I'm wondering if maybe gold coming off the highs is now just starting to ebb out of the Aussie dollar as well, and that. But yeah, as I said at the start, I don't think we're done with the risk trade yet. There's still a cloud hanging over, even if the Iran thing fortunately hasn't developed into anything massively significant. But the market I don't think is ready just to complete reverse risk trades on the back of that yet. But technically, we're just trying to hold below around this break point, so that could be a bit significant. We came close to a sort of bit of an on-off level, 64.50s, and those prior lows that we got down there into the 40s back in Feb. So we're not quite getting down to those lows. If we do continue this down move, then we've got a potential to head into that this big traffic zone down here, down towards 64s. And then maybe even towards down towards the 63s, 62s, which I know Dale's been looking at, keeping an eye on the old face show. But in the meanwhile, it's not suggesting it's a big break as of yet. As I say, this 64.50s has been a bit of an on-off level as well. So at the moment, go with the dollar. But again, if power pops out and says hawkish expectations are going too far, they're still going to cut. then we're probably going to be back in the 65s, maybe even back up towards 66s again. So you can't marry a position for too long. If you've been short this, make sure you're banking some profits and protecting the rest, just in case we get another flip around. Another one, this one I added to on Friday, dollar MEX. I was short 61, wrote this down. We're looking at this area here again, this zone, to see if it was resistance. We actually got a break of it, and this was coming amongst all those risk headlines. So I pushed my stop up above 1680s, just to keep out the way, and then I headed back into this zone at 69s, just because I thought, yeah, if this headline doesn't come to anything, this might be a pair that gives up a bit more on the risk move, and it has. It's back down again. Still think it's not out of the woods. It needs to get back below 1650s for me. Then I'll bring my stops back down again. But at the moment, yeah, this is one pair that's moved with the headlines from Iran. So happy with that one as well. Okay, you're probably still in your Euro MEX, similar picture, I should imagine.
Yeah, very similar. Huh? Euro dollar doesn't move, so it's the same. It's the same picture on dollar MEX and Euro MEX. Yeah. I'm just getting a, let's say, barring the broker tax. I'm just getting that little tad more carry than you get being long mix, with the euro rates being a bit lower. But yeah, I mean, for the time being, don't change anything. I mean, we had our risk on the position going into the weekend. Of course, we all know that when risk off is hitting emerging market, gets hit a little bit. We did have it. Now we quieting back down, and the mix is quieting back down as well. It's still, for as long as we don't get any disastrous, we have to watch both things. The economic data, and then especially out of the US, of course, in Mexico as well. We need to watch the economic data. We need to watch risk, and then we need to watch what the Banxico wants to do. We do have the next meeting as well, early May. So let's see what they do over there. So far, they are in a 25 BP rate cut scenario. What they did before. Let's see if they move on to something more dramatic, doing 50s or so. But they were very neutral on the meeting. So for the time being, I think until then, unless unexpected risk events, it should still be a pretty smooth sailing for the mix.
Yeah, very much so. I just want to highlight this because I'm always telling people, don't mess with your stops. Don't mess with your trade. If you have a trade plan, trade idea, don't mess around with it. But there's times when it sometimes becomes good to do such a thing. Like I had my stops, I was short 1661. I had my stops at 71. If I'd have kept those stops, I would have been tipped out, and then I might have had the ump and not got back in or whatever. So just for this one point, I moved my stops up just to try and get out of any noise. Obviously, I increased my risk a bit because if something big did happen, I'll probably come in this morning and my position's blown up anyway. But sometimes just making a bit of an adjustment to take into account conditions can sometimes help you. Although, as I say, I wouldn't do that all the time. But there's just times, and this is an experience thing more than anything else. You just feel like you need to keep out the way of any potential trouble, or try and keep out the way of any potential trouble. But if we get back below 1650s, I'll have my stop right back where it was, probably just above that high instead of the 71 I'd had previously, just taking into account the price action there. But yeah, don't change your plan, but sometimes you can change your plan. Okay, anything you want to look at for this week?
Well, Deraj is asking for gold. I can look at that.
Yeah, let me ping it over. Where are we? There we go.
Okay. So we had this big blowout on Friday into the I call it peak nervousness on the Middle East situation. Yeah. we ran up like really fast. Technically, there was not too many levels around here. Anyway, not before 2480 or so. But then at the end of the day, we saw these $100. Yeah, I mean, meltdown because there was this news about things will be contained or will be. I don't remember the exact wording that they used. To say that it wouldn't be an out-and-out war or dramatic thing, but then we lost about $100 here very quick. This is typically, as I said, peak nervousness, and then we come down. So we can now put a level on it here, and there's this. Where was it? And here we have this. This extension here, 2320, and then we have the first retracement level. Yeah, the first fib level is 23. Let's say 2026 is a bit of a level that we could monitor. What I also noticed this morning is that we did not have our typical Monday morning Asian spurt higher. Yeah, it's been volatile, obviously, because of the Middle East situation, but we didn't have like a massive buying spree coming in from Asia. So that's perhaps a little bit of a change, which makes me think, of course, always keeping risk in the back of our mind and seeing what the Israelis are up to right now, because seemingly the ball is in their camp. What's going to happen? But I wouldn't rule it out. I wouldn't even rule out, if we get, and hopefully that's going to be the case, if we get a really calming down of the situation, just from a market point of view, okay, I think I wouldn't rule out a move back to 2255, 2270. Because that's we can put this here as a channel, and that's your top end of the channel where it broke out here. Also, a decent few fibs around here now in this zone. So I think 2255.70 is going to be where we need to monitor if we get more setbacks here. Okay. And that is what I'll be looking at. Are you talking about gold, Ali? I mean, I'm not looking at 1 hour charts in this kind of scenario. I mean, they're probably getting traversed like saloon doors, more or less. Oh yeah, okay. All right. Everybody looks at stuff that they want to look at. I should perhaps look at shorter term, but I just refuse myself to look at shorter term, especially in periods of volatility like this. If you put in a nearly $500 rally in the space of 2 months, I don't want to get on too tight time frames myself, because it's just not the way I trade either. So this is it for me here. Yeah, I can see your 25 and a bit because this is would be the two extension of the setback that we had 2022. But okay, it's just on a technical basis. Personally, unless we get really bad numbers starting to pile up out of the US, which is the case, which is possible, I always say like end of Q2 into Q3, that is where it will be money time. So if the numbers hold up, I don't see a reason for this running much further. But if the numbers start to turn around and get weaker and weaker, we may see a surprise we may see a continuation actually of gold and all the metals and flying high. Silver, quick look. We just ran shy of the roaring kitty high that we had at $30. No, it's even further away. Yeah, so we just went short of it. I think 29 3/4 or so. So what we printed. So I took some off on Friday of my long-term silver. I've seen this on Twitter, so thank you very much for the one that I copied it from. we could actually see a bit of resistance now, just around 28.5, 28.60 on silver. All right, and I think a bit similar to what's happening in gold. We could see a bit more retracement back down. I think it wouldn't be anything out of the ordinary. If we get back down 27.5 around, that would not be anything special. But the big break zone here around 25.5, that's going to take some work to break back down. So of what I let go, if I see any move down in the mid 25s, I'm going to start to build up again, just continue my long-term play. I'm just going to reply to what Ali said on the euro sterling. It's still very much a range play, okay? But yeah, your level here in the 20s, we've seen it bounce from here all the time, but then at the same time, it's capped up in this 80 area. So for the time being, 2080, and then we just trade 85, 85, 84, 90 on. If you want to catch a knife in the 85 20s, why not? I mean, other people do, and it's been with relative success. Okay, I don't see too much to do right here and now on the euro sterling. It's but you can trade the intraday ranges. Well, why not? Ryan, back over to you, mate. I'm looking at the clock. It's enough for a Monday morning.
Yeah, very much so, mate. Thank you very much for all your good stuff. Gets kicked off for the week. Thanks everyone for coming to the Flow Show. Hope you all have a great week ahead. Lots to look at, lots to discuss. So we'll see you bright and breezy tomorrow. Have a good one, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.